All right, people, we're not meeting today because of the terrible weather, and we still will continue on our agenda. And now, if you are looking at the Canvas page, this is us, Finance 340. And if you scroll down, and you will see the second module of this class, and this is under the Home button. You will see we're doing financial statements and forecasting techniques. So we're gonna first do a review of what we have learned in the principles class about financial statements, and then we're gonna conduct pro forma analysis, and pro forma basically means the forecasting. And also we will do a quiz next Wednesday based on what we learned today about financial statements and all these forecasting techniques. So the first one we want to do here is the financial statements practice. So if I click in here and let me just download this file. Okay. So what you'll see here is the basic form of a financial statement. So you have an income statement in the middle, and you have a balance sheet, and you also have the statement of cash flows. So this have been already covered in the principles class, and we just want to work on it and try to see some key items here. For example, if we look at the income statement right here, what would be the item, okay, which is marked in blank under sales? So you should know that from our previous analysis of a Sweet Pete's candy shop, and we focused a lot on the gross profit calculation. And gross profit basically is sales minus cost of goods sold. Okay, so let me just put the words here. Is a cost of goods sold. So this is a variable cost which varies based on the amount of units sold. All right, and then you get a gross profit. As I said, gross profit could be measured at a per product level, like the gross profit margin per candy class, per lollipop, or per candy. And after that is done, we need to deduct all these fixed expenses, including SGA expenses and all other fixed expenses. And what else do we need to subtract? And you will see that after the subtraction, we will get a EBIT, earning before interest and taxes. And you should know that this one is an accounting item, it's not a cash item. So that means here we are doing something to that is not a cash item. So let me just highlight it, and this is our guy. Its name is Depreciation Expense, and that's from years and years of deduction of your assets value. And that deduction is not really a cash outflow. It's just a purely accounting term. All right, and if we move down, we need to subtract interest expenses from EBIT. Then we get earnings before taxes. And how do we calculate taxes? So this is basically the amount of earnings before taxes, aka taxable income, multiplied by the tax rate down here, 40%. All right, and then you will get net income, just a nice and easy. The net income equals to earnings before taxes minus taxes. All right, and then the next item, actually, we're done here for income statement when we see net income, but usually on the income statement, we're gonna see dividends. And the dividends here could be an arbitrary number decided by the management of the firm, or it followed a payout ratio. So right here, the payout ratio is the 49.75%, which means that percentage of net income will be paid out to shareholders as dividends. So let me just highlight it here. Okay, and you will see dividends here equals to the payout ratio multiplied by the amount of income, net income. All right, so basically this is a little review of an income statement. So you should know all the items here and how to calculate some key items. All right, now let's look at the balance sheet. The balance sheet is made of assets on one side and liabilities and owner's equity on the other side. And what I put here is the calculation of accumulated depreciation. So, you know, our plant equipment each year goes by, then we're gonna see a value deduction of this fixed assets, and that value deduction again is called depreciation. And accumulated depreciation basically is years and years of depreciation summed up. And if I highlight this one, just to tell you the answer, it is this number. How do I calculate it? It is the accumulated depreciation of last year plus the new depreciation expense this year, and that new depreciation expense comes from the income statement. All right, and for return earnings, it belongs to the total shareholders' equity, and the return earnings of this year equals to the return earnings of last year minus the dividends plus net income. All right, and that is a so important formula. I required all my principals class to remember that. Okay, so this is how you use Excel to do it. All right, and then the last one is the statement of cash flows, and you will see we're gonna take a look at all the items here on the balance sheet, and then get a change of all these items. For example, account receivable, inventories, accounts payable, and all the others. And what else do you need to look at? You will see the change of plant equipment, which is also on the balance sheet. Plant equipment by itself is on the balance sheet. Short-term notes payable is on the balance sheet. Long-term debt is on the balance sheet. But you don't see change of retained earnings, and you don't see change of accumulated depreciation. All right. So the change of accumulated depreciation from last year to this year basically is a depreciation on the income statement, and also the change of retained earnings, okay, from last year to this year equals to net income minus the dividends, and the dividends here is directly borrowed from the income statement, which is 22,000, but you should know it is a number we subtract, so that's a negative. And net income is a number directly borrowed again from the income statement, and they two, when we add these two together, net income plus negative dividends, that is the change in retained earnings. But we put them separately because net income and cash dividends, one is about operating activities, and this one dividends is about financing activities. All right, and also you should know that when we fill in the numbers here and there, we need to know whether the given item is an asset or is a equity or liabilities. For example, accounts receivable, if you look at the balance sheet right here, we check accounts receivable is right here, and that's assets. So when assets increase, when this assets increase from a 335,000 to 402k, then that's gonna cause a negative cash effect. So for this one, the number should be negative. We use the old minus new, or the negative of new minus old. So that's how we do it. So this is the Excel formula. And for accounts payable, this one is not assets anymore. It is actually belonging to liabilities and equity. And when anything happens for liabilities or equity, when they increase, that's gonna cause a positive cash effect. So this one, you see with accounts payable increase from 145k to 175k, you will see the cash effect is positive. All right, and then we will check all the other items, and I'm not gonna go over one by one, and you will see in sum we have all this total cash flows for three groups: operating, investing, and financing. And then we're gonna add them up. Okay, this is the sum formula of Excel, just to add all this subtotal up to get the grand total. And this grand total is the very last finalized item on the cash flow statement. And this basically is the cash change due to all of these activities taking place in the new year. And if you look at the cash and equivalent right here, this number is actually based on the cash this year, okay, based on the cash last year plus the net change cash right here. So Now everything clicks, so that means they are all get connected. So that's the basic financial statement analysis, and we're not doing any homework or quizzes on, not quizzes. We're Let's put it that way. We're not doing any. You don't have to follow this or submit any homework, but we will have a quiz based on this um, basic items or the key items here on the financial statements. Okay, so this part is done. All right, and now let's take a look at the pro forma analysis. Let's first go with an easier one, and this is directly from your textbook, case 5. And if I click here and open up the file, and now we're talking. So it's not just basic financial statements, it's really about forecasting. For example, here is our past 2 years, 2002 and 2003. I know it has been about 20 years, but that's how the textbook gives us. And what is required of you for this assignment? And we should call this an in-class exercise because this should be done in our in-class activities. What you need to do there is to calculate all these numbers marked in red color. Okay, you will see there are some numbers in black color and some numbers marked in red. And for now, there's no formulas behind any of these red numbers. So you are going to place some formulas there. Okay, so that's all I need to do. And let's first go over the existing, okay, financial statements for the 2002 year and 2003 year, and before we move to the 2004, the estimated year. Okay, so for the gross profit, and this is your start. How do we get gross profit? We're going to use the sales minus cost of sales. So cost of sales is another name for cost of goods sold, right? And then hit enter, and then you just drag it to the right. Okay, you place your mouse right here and then drag it to the right. And then you have operating expenses. So these are fixed expenses. And to get operating profit, aka EBIT, earnings before interest and taxes. So that's the gross profit minus the operating expenses. Okay, and then drag it. You see, although the output, the appearance does not change, but I did input formulas behind the numbers. And when I grade your submission, I will check the formulas. If you just give me the original file, yes, it looks the same as a completed one, but if there's no formula showed up, then you would get 0. Okay, so let me just be clear. It is the formulas I'm grading here. And here, there's nothing to work on. These are the assets part of the balance sheet. You have accounts receivable, inventory, other current assets, and so on. And for total assets, just sum them up. Okay, just take the sum. Hit enter, then you're gonna drag it. Okay. Okay, and for the sales growth, okay, for the sales growth, basically that asks you to calculate how much does your sale grow from last year to this year. Okay, you see the number from a 4666 to 4792 that increases, but I want you to give me the percentage. All right, so what you're gonna do here is to put an equal. That's how we start a formula. The parenthesis sign, and then the new year minus the old year divided by the old year. Okay, this is a required knowledge. How to calculate the growth rate, how to calculate return. All right, it's new minus old divided by the old. That's one way to do it. And another way to do it, which is just a math, a simple math formula. You can use a new divided by old, the minus 1. So you don't have to input all these parenthesis symbols. So it's really you call what to use. All right, and for gross profit margin, so we're gonna use the gross profit divided by the sales. All right, then drag it. For operating expense as a percentage of sales, so we're gonna use whatever we have here for operating expenses divided by the sales. Okay, there's not a name for it, so we just do as what is asked. And for the operating margin, this is your operating profit divided by the amount of sales. Okay, then you drag it. Okay, and for receivable turnover, this is basically your sales divided by account receivable. So we use sales divided by account receivable right here, and then we drag it. You can see the number here is slightly different because we're using different years of data. But if you just decrease the decimal, you will see the number is actually different. Okay. Yeah, if we show some decimal there, the number would be a little bit different. Okay, and here for account receivable days, we also call it average collection period or days sales in account receivable. We're gonna use 365 days divided by the receivable turnover ratio. The receivable turnover ratio is telling us how many times in a year your outstanding receivable is getting collected in cash. So right here it's 8 times in a year, so roughly that's 46 days to collect your receivable into cash just once. Okay, just to drag it. And for inventory turnover, we're gonna use well, it depends on whether your inventory is related with the raw materials or finished finalized product. So if you use if your inventory is about is to store the finished product, then the finished product should be marked with the sales price divided by inventory. Okay, but if your inventory stores all these raw materials, and you know that raw materials are marked with in cost goods sold, so we should use cost goods sold here divided by inventory. And for this particular example, the textbook basically is assume your inventories are about the raw materials. So the inventory turnover ratio is about how often or how many times your inventory get filled in and used, filled in again, get used again. So how many times does this process happen? And on average is about 8 times in a year. So the inventory days is 365 divided by this inventory turnover, and that is telling us how many days does it take for us to replace our inventory once. So we used up our inventory, fill with the same amount of a new inventory, so that's the one process. And that process is going to take 46 days or 43 days depending on the year. All right. And for other current assets over sales ratio, so we use whatever the item here, other current assets, current is basically for short term, divided by total sales. Okay, and for PPE turnover, and this is a tricky, so we're gonna use sales divided by property, plant, and equipment. Okay, then drag it, decrease the decimal. Okay, and other non-current assets turnover, so that is the amount of sales divided by other non-current assets. Okay, just to drag it and decrease the decimal. And for total assets turnover, so that is a ratio for efficiency. We're going to use the sales divided by total assets. All right, sales divided by total assets. And we want this ratio to be as high as possible because we want to hold the denominator as low as possible. We don't want to have too many assets because that's going to cost us money to maintain or hire people to run the assets. But we do want to have a lot of sales. So higher sale, lower assets indicate higher assets turnover ratio. Okay. And for return on assets, we're going to use net the profit here divided by your total assets. Okay. Well, the number here is not quite good because I have not considered the fact that we need to think about the taxes. All right. So right here, what I used is operating profit. Should I use that? Yes. But when we calculate the return on assets, it should be net profit. And net profit here is an after-tax profit after interest is paid. But here we don't have an interest payment. So we just directly use the operating profit, okay, the operating profit, which is in B8 times 1 minus 35% tax rate. Okay, so that's your net profit divided by total assets. And then you're going to have this return on assets. Okay, all right, so that's the financial ratios and all these key items on the financial statements for the existing year. All right, so far everything's nice and easy, and all these ratios were covered in the principles class. That's why I went over pretty fast. All we need to do is to check the formulas here and there to make sure they are in place. Okay, now let's do forecasting. So 2004, according to the textbook, is our forecasting year. And how do we forecast the sales? So basically, we're assuming the sales growth rate is the same as last year. So which means last year your sales grows at 2.3% from the year before, and this year it should grow by the same amount, 2.7%. And we are going to use whatever the sales we had before multiplied by 1 plus the sales growth rate. Okay, take a look, then hit enter. Okay, so this is our forecast to sales. So from 2002 to 2003, the growth rate is 2.7%. From 3 to 4, that's another 2.7% growth, and that's a fair estimation. And for the cost of the sales, it could be forecasted. However, here's the trick. I know the textbook is tricky. We want to know the gross profit first. Okay, we want to know the gross profit first and the gross profit margin first. So the textbook basically assumes in the next year, the pro forma year or the estimated year or the forecast year, however you want to call it, in this year, the sales growth is the same, the gross margin is also the same. You will see the 17.9%. So now we know how to calculate the gross profit based on this given rate. Okay, so when we calculate the gross profit here, it is the sales in the new year multiplied by the gross margin, and this is the hint I have provided to you, times this 17.9%. Okay, then I hit enter. And for the cost of sales, it would be the difference between sales and the gross profit. Okay, so it's really like forecasting backward. We know the gross profit margin first, then we'll figure out the gross profit, and then we figure out what the cost of sales would be. And there will be some other ways to figure out the cost of sales in a different exercise, just let you know. All right, for operating expenses, and you will see that the ratio of operating expenses to sales is the same as last year. So following the same rule, we're going to use the same ratio in the pro forma year, which we assume to be. Use that ratio multiplied by sales. So I'm going to use this ratio multiplied by the sales in this pro forma year. Okay, this is how we do it. And for the operating profit, we just do a subtraction. Gross profit minus the forecasted, well, they're both forecasted, minus operating expenses. So that's your number. Okay, I think we are making good progress here. And the next one is accounts receivable. And right here, we assume that account receivable would be the uh, same method. So you will see the receivable turnover here is 8. That's the assumption here. So we can just use sales divided by 8. Okay, divided by 8. If we do that, you will see the number is slightly different because in the textbook, the number given to you is 8. So we should maybe use 8.03 to be more exact. Okay, now we're talking. You see, let me just undo this. Control Z is for undo. Control plus Z is undo. Okay. Okay. So let me Control Z again, Control Z again. All right. So just to move back, here is our gross profit. Let me do it again here, and you will see the number is 613. And to be more exact, we want to use the number of a receivable turnover, which is the same as last year. Okay, not 8 sharp. Okay, it should be 8.03. So how do I get this accounts receivable? So we're gonna use a sales divided by the receivable turnover ratio. Okay, so it's like knowing A plus B equals to C. Then we use A and C to solve for B. All right, or we know A times B is C. Then we use A and C to solve for B. Okay, so that's how we perform this task. And for inventory, well, again, our inventory is related with raw materials, and that is related with the cost of goods sold. So I'm going to use the cost of goods sold or cost of sales divided by my inventory turnover. I just calculated. So the inventory turnover here, well, the textbook gave us that number at 6.9. I think that is out of reason, or is very arbitrary. So we just follow the textbook, right, to make things all the same. Okay, click this 6.9. Again, this is not a calculated number. I'm sorry. This is not a calculated. It's directly provided by the textbook. Okay, then I hit enter. So this is my inventory in the pro forma year. Decrease the decimal. And you also see other current assets. So same rule. I'm going to use a sales divided by the ratio I calculated or given by the textbook. So the other current sales ratio is here, 5.0%. Okay. Oops. So use the sales divided by the other current ratio. Oh, sorry, this should be multiply. Okay, because that's a ratio, it's not a turnover. So turnover stands for number of times. So that could be 8, could be 13, but for the ratio here, it's 5%. So we should multiply that ratio. Okay, so this is the number here. Again, we do not divide that number, we multiply that number. Okay, just to highlight what I just did. For example, these two numbers, one is a sales divided by the turnover ratio, and another is sales multiplied by the ratio of sales. So what's the difference here? Okay, so you should know that cost of sales with inventory, so the ratio here is the inventory turnover. When you calculate the inventory turnover here, it is the inventory divided by cost of the sales. All right, divided by cost of sales, and so if we multiply cost of sales in the new year to this ratio, it would be, let's see, cost of sales, just use cost divided by inventory. Okay, and this is for the 2003, and then cost divided by inventory in 2004, which is your pro forma year. I use E standing for estimate. Okay, basically we assume these two ratios are the same. And if you want to solve for inventory right here, if you make them equal to each other, and you want to solve for the inventory here, okay, then what do we do? So we gotta use this ratio, and we're gonna use so the inventory of a 2004 E would be the same ratio, the costs in this year 2004 E, okay, divided by, okay, it should be divided by this ratio of last year. Okay, so that's basically math. All right, so when you're solving for the denominator here, which is your inventory of the pro forma year, so we should use the cost of sales in the pro forma year divided by the ratio. But for the sales percentage method, for example, if we are trying to solve for this other current assets or net property and plant, okay, so you should know that this other current assets divided by sales equals to other divided by sales. Okay, so 2003 ratio equals to 2004 ratio. Right, so let me just put some border here. Okay, and if you try to figure out the item other in the pro forma year, okay, it should be sales. Okay, it should be sales in the pro forma year times, okay, it's times this time of the same ratio, because we're solving for numerator here instead of the denominator. Okay, so here the inventory we are trying to forecast is the denominator of the ratio, and here other current assets the numerator of the ratio. So that's why we're using the related item either divide or multiply the same ratio of last year. Okay, so that's just some math proof. Okay, so where were we? So for the net property, plant, equipment, or PPE, we should use a sales in this year divided by this PPE ratio or turnover ratio. So we have a PPE turnover that's a 4.6 given by the textbook. All right, and you will see that the number here is a little off, but it's okay. We shall use the number of last year. Okay, and now we're talking, so now the number is correct, so we need to do something right here. Okay, and that for both the the receivable turnover as well as the PPE turnover. Okay, for other current assets, so this non-current assets is embedded in this turnover ratio. And again, this key item, other non-current assets, is the denominator of the ratio. The numerator is the sales, and that's a 7.1. So when we do this pro forma analysis, so we're going to use the sales divided by the same ratio, 7.1, which is close. And then, okay, and something is off here. Okay, so here we just use the ratio, which is assumed to be the same, but it's not really the same unless we just use Excel to connect the number. You know, the textbook has some rounding issues. It's just to copy the number and skip some decimals, and that could cause some dollar off from the textbook answer. So for now, just stick with my just use this same ratio as last year instead of using the textbook number. I know the textbook copied it, skipping a decimal, which is not exactly the same. Okay, so right here, this you put in some formula. Okay, let me just mark in red, and I will check your formula as well, and that is your non-total current assets. Okay, non-current assets. All right, and for the total assets, so all you need to do here is just to sum them up. Okay, take the summation, and then that's the number. And I know there's some $1 off from your textbook answer. That's completely fine. Okay, because the textbook had rounding issues. All right, and now we have done all of this works, and oh, still we need to finish this one because it doesn't have a formula here. So let me just drag it all the way to the right. Okay, nicely done. And this total assets turnover, just drag it, so you will see the ratio is slightly different. And for this return on assets, again, we just drag it. All right, nice and easy. Okay, as I said, there are some rounding issues, so don't worry about a slight difference from the textbook answer. And now we are basically done with this one. So just to check your formula view of this spreadsheet. Okay, you will see all the formulas are in place, marked in red color, and some formulas here are plugged in. Okay, so that's all you need to do for this assignment.